Hi again, everyone. My name is Safaya Mohammed, and I'm your host this afternoon. Just a little bit about me. I'm a social media content creator, master communicator, and TV presenter. And I am very pleased to be here with you today. On behalf of the Scotia team, welcome to Scotia Insights, episode 19, Investing Through Uncertainty. The Scotia Insights series was launched 6 years ago, and we are happy to continue for another year. This meaningful thought leadership event continues to connect us with our customers and provide a platform for engaging discussions and building relationships. For now, we remain web format, but we are hopeful that very soon we can move to hybrid or in person again. Before we meet today's featured speakers, let's review the house rules. Number one, you're encouraged to ask questions on today's topic by entering them into the meeting chat. Next, only when both speakers have delivered their presentations, we'll move into the discussion. Third, for the discussion portion of the agenda, when your question is selected, we'll unmute your mic so you can speak. And now, without further ado, let's get down to it. So joining us from our Scotia Global Asset Management team in Toronto, we are pleased to introduce Daniel Carabajal. Daniel joined the Global Portfolio Advisory Group as a fixed income strategist in 2013. Prior to joining Scotia Wealth Management, Daniel spent 5 years in the emerging markets research team at RBC Capital Markets, where he focused on investment strategy research in foreign exchange markets, local rates, and external debt. Earlier in his career, he worked as an equity and macro investment analyst in Argentina, covering Latin American markets for a local investment dealer. Daniel has joined us today to share the international perspective and how we can tap into quality investments in the current market.
Good afternoon, everyone. Thank you for joining us today.
And joining us from our Scotia Investments team in Trinidad and Tobago, today we have Christopher Clark. Christopher joined the investment management team in 2018. He is responsible for oversight of over 4 billion TT dollars in assets under management invested across both local and international markets, inclusive of Scotia's 3 TT dollars mutual fund portfolios. Christopher is a respected expert in the local industry with over 10 years experience in investment management at leading domestic financial institutions across mutual funds, pension plans, and insurance.
Hi, good afternoon, everyone. Thanks again for joining us here today.
I'll now hand you over to Daniel to share the international perspective.
Thank you, Safaya. Hello, everyone. Thank you for joining us today. It's really a great pleasure to be here joining through this webinar. We are living in challenging times, so I think this is a great opportunity to share our thoughts in terms of what is happening in this world right now. So I will start in this challenging time. So we've seen geopolitical risk, we've seen inflation. Yes, inflation. So something that sounds very familiar for Latin Americans. So through the years or decades, many Latin American countries suffer from inflation, even hyperinflation. That happened. I will make a very short story. So when I was a kid, I was living in Argentina. So I recall that we were experiencing hyperinflation. That means 5,000 inflation rate per year. So something crazy, something that even a kid can understand. But I remember my dad going to receiving the paycheck, going to the supermarket, saying, "No, we have to go fast because prices are changing." And effectively, we're changing every day. So and people in the province that I was born, they were it's a sugarcane province, so probably produce sugar. And I recall that my dad were storing sugar boxes at home just because in that way they preserve the money. Having bills, anything, doesn't matter. So you have to have something that you can trade in the future. Probably that was my first experience with inflation, and probably marked me a lot because since then, so Argentina at that time suffered in many aspects, not only the economic, but social. There was a changed regime, and finally, after many years, so inflation at the end was under control, but demanded a lot of sacrifice from the people. And what happened is like a new government introduced new reforms, privatization, all the state-owned companies were sold. And I recall that foreign banks came into Argentina, seeing opportunities. And I remember that probably now that after many years, I've seen that probably inflation was the trigger for me to pursue a career in capital market, because since then, what for me was a continuous will trying to understand why the market reacts to this, what's the economy, why the economy, or what, for instance, government can control inflation. And that's is something like probably is happening again. So with this short introduction, I will just, I think in this presentation, my objective is to give you a value proposition. So basically what I will give you is just some tools that you probably will help you to understand this moment, and probably I hope that serves you like a compass to decide your future investment decisions. With this, I will start my presentation, and let's move to the first slide. Thank you. Okay, so I will start, usually people start with, okay, explaining things. I will start from the end. So what is, and summarize everything in a few concepts. So you have right now an idea what is happening in this world. First of all, what we are experiencing since beginning of the year is deterioration in economic growth. Probably a recession, not sure right now, but I think risks are increasing. So that is something that market is considering day by day. So after getting more economic data, so that is giving some sense of about the outlook. So first, economic growth outlook deterioration, potentially a recession. 2022, probably not. Probably we see something in 2023. Other important concept, I already started with the high inflation. So at the end of last year, inflationary pressures were, most people thought that was something transitory. Well, it became more persistent. So, and this is something that markets are making a lot of nervous about the consequences of holding high inflation for longer. So the other important factor that is I want to mention is like since beginning of the year, most central banks and government start reducing all the stimulus that started since the pandemic. And this is also something that, in fact, slowed economic activity. So under these circumstances where plenty of factors are affecting the economy and the markets, key things that to take into account here is like holding high quality assets will preserve your capital. And the second important concept here, diversification. Diversification will help you to mitigate this high volatility. Okay, so this is a little an explanation. So since the beginning of the year, economic growth starting to deteriorate. We have a couple of important factors, not only about the stimulus that was reduced, but it's also about geopolitical risk. So everyone is aware that the Ukraine-Russian conflict provoked a spike in commodity prices across the board, not only energy and gas, but also soft commodities. With this event, it's changed a little the game because inflation become more persistent and it's affecting the market. And what is interesting is not only affecting fixed income, but also equity. So let's move to the next slide. Let's see what was the performance of the different asset classes since beginning of the year. So if you see on the left, I'm not very proud, but that is what happens. So equities and fixed income post negative returns. In the past, I have many experience with investors, like thinking like in general, when you invest in a balanced portfolio, that's basically some part equities and some part of fixed income. So at least one of the sides of the asset class perform better than the other one. So for this first part of the year, that was not the case. So both asset classes performed really bad. Fixed income, not only sovereign bonds, but high yield bonds, corporate bonds, and in equities, if you see in different regions. So only Canada, because it has a little more exposure into commodities, even posted a negative return, but much better than other regions. Only commodities performed relatively well across the board. Let's move to the next slide, please. Thank you. Okay, the diversification. So that is one concept that I started at the beginning. Why diversification is important. So in general, people have this common phrase like the idea of the don't put your eggs in just in one basket. So, and that's correct. I have no idea. That is the concept of diversification. But I will add one more thing about that. And this is probably a little more adding value to this. Is like, it's not just holding eggs or just not put all your eggs in one basket. On the contrary, you have to put just one egg in one box, but also try to other person carry the bag, separate to different people. So because you can hold two bags or two boxes of eggs, a basket of eggs, and basically if you fail, you smash with eggs into the two boxes. So in general, separate with different people, and this is the way that diversification works. Because sometimes correlation or the idea that one asset class move in the same way that the other asset class will not give you that diversification. So always think about diversification in the way that you have to reduce the relationship within the performance of one asset class with other asset class. And this will be an important concept if you want to go through this storm. Let's move to the next slide. I will explain a little more about volatility. And this is something that people can read on the newspapers. Oh, volatility is high. Also, and in fact, what happens in the first part of the year is like volatility spike. In the last since 1940, there were levels that the volatility we've seen in the first part of the year, we experience only 5% of the time. So it's very rare, it's not common. But in general, what happens, so we analyze the different periods of volatility through the past, over the years, different experiences for different reasons. But we conclude that, yes, volatility spike in general affect the equity market, and you see probably a sell-off or a big sell-off. But what happens is like after that particular sell-off, and if you go through the, let's say, 12 months, 18 months, equity market recover. So in general, recover with a median return of 15%. So volatility is a concept that is related with risk, but volatility is quantifiable. So you can quantify the level of volatility in any asset class. So just one way to reduce this volatility is just be diversified. But volatility also helps you and give you the opportunity to see new entry points for the market. So volatility is sometimes good. So this it depends how you use it. So right now, volatility continues to be high, but what we are seeing and experiencing some pockets of different asset classes that can give you an attractive entry point. Okay, so what is our view about the global economic growth? Here you have three different scenarios that in our team we were evaluating. Every of these scenarios has different probabilities. Probably the number one is the one that are more, or we think that will materialize, or more probably materialize. So we expect that moderating growth probably not a recession in the near term, but recession risk would be rising. And if there is a recession, probably would be a mild one. This is a scenario that we consider like the most probable. We believe that central banks would not be able to tight rates in a very aggressive way. There are some other factors that will play, including the idea of some secular forces that work in the market that will prohibit the Fed to hike rates unless they want to face a deep recession. And this is something that is important to mention because central banks has been very I would say, very concerned about inflation, and they focus all the efforts in the recent meetings in trying to tackle this particular thing. So any of these scenarios, and a scenario of moderating growth, and a scenario like number 2, and we see a short downturn, or we see a scenario 3, we see a very long or prolonged recession with economic growth declining faster because central banks hike rate very aggressively. So all these 3 scenarios have different probability. We think that the number 1 is today is the most probable. The final outcome, in our view, will determine by inflationary pressures, what will be the central bank response, and geopolitical uncertainty. So these 3 concepts will move the probability from one side to the other. So we talk about inflation. Inflation is something like, in general, we experience a lot in Latin America, but not so. We've seen, I think in the 80s was the last experience for the US to have very high inflation numbers. So right now, a number of factors have contributed to this inflation. Most important is the commodity prices. The other part is the supply chain disruption that happens since the pandemic. So we've seen that demand picking up. So that when the demand is picking up, so basically demand more products. So it's an imbalance between demand and supply, and also the increasing wages. So all these factors are right now combined together and pushing inflation almost worldwide. So I say almost worldwide because there are some regions that are still facing low inflationary pressures, but they are building up. Those countries are much more in Asia, China, and Japan. So, but the rest of the world is like a common. It's all are experiencing high inflation. We've seen recent numbers in the Eurozone also with inflation picking up. So that is, and probably will not change anytime soon. So from the inflationary perspective, so there is one thing that is important. It's about inflation expectation. Those one has to be, or there are secular forces that keep it anchored. So we will not see a hyperinflation that we've seen in Argentina and many others. So there are secular forces like indebtedness, digitalization, aging demographics, globalization that will put inflation in the long term to more close to the target level of what the Fed is looking at, the 2%. So just to give you a brief idea about what central banks are doing right now, hiking rates. So if you see, most of the major central banks are already climbing rates. Hiking rates for central banks affect mostly the short end of the curve, so short-term bonds. So that's the ones that are most affected for this particular event. So not so much the long end of the curve, or bonds that are in 10 years, 20 years, 30 years. Those have other factors that works, not only the central bank's rate decision. So there are many risks that probably put some pressure on long-term yields. The central bank is one, but it's not the most important. If there is an economic slowdown or we see a recession, probably long-term yields would move lower. So what is important here is like we are in a trend much more synchronized across the board that central banks are hiking rates just to control inflation. Commodity prices. So just very brief. So we've seen a spike in commodity prices due to many geopolitical factors trigger an acceleration on some of commodity prices. So that is across the board. What matters most is about how these spiking commodity prices will start affecting consumer spending. And this is something that the market is very keen to focus on. And every single economic data that we've been monitoring in the short term, like even leading indicators suggest like we are seeing some resilience of consumer spending, but probably will not last for a while, because what happens is like it happens to everyone. If you see gasoline prices moving up, so people probably travel less. So that's and that affects the economy, that affects the economic activity. So also businesses will look to insulate profit margins, but passing the higher commodity prices to the consumers. So you will see more inflation on the consumer from the consumer perspective. So commodity will continue, high commodity prices will continue to adding pressure in inflation. So that is one thing that probably the central bank cannot control so far. So, but it's something that demand and supply will work at some point and will stabilize the prices. What happens with commodity prices that they are very volatile. Okay, so now I will summarize just very brief, and this would be most related with the asset classes. So our view in terms of the equities. So what we see right now is relatively, I would say most firms start revising earnings growth for forecast. So they are seeing that economic outlook is not so good. So they are reducing expectations ahead. So, and particularly this is not good for equity. So if you hold equities in general, you look for firms that are improving earnings and not declining earnings. So, and probably that is one of the factors. One of the factors is inflation that obviously affect profit margins. So higher rowing cost is affecting. So sometimes it's not very easy to translate or to move into the client price. So it's sometimes not as easy. What we see on the equity is like, yes, we see some correction, this acceleration in terms of earnings growth, but we still believe that there is valuations are relatively fair. So they move lower, but what we've seen is like return has not been so bad as expected. So probably there is something that we have to see much more in the long term rather than just the next quarter. So how this inflation will continue working in earnings. But so far, if I have to give you an advice or a suggestion in terms of what you have to take into account when you see your equity exposure, is you have to be just focused on firms like have relatively good return on investment capital, they have leverage under control, and they have business sustainable advantage. With these particular three factors, probably you will be in better condition than other people who holds other type of portfolios. So bonds, very quick. So it's hard to defend bonds or to see that the bonds will outperform when we see rates hiking. So, but we believe there are most of the move on central bank rates has been already embedded in prices. So we've seen some pockets of opportunities, mostly in corporate bonds. There are very high quality bonds that are have a good, relatively low leverage, good business, so that can give you a relatively attractive yield. In general, we prefer investment grade over high yield at this point of the cycle. And just to finalize, next slide, please. We'll just 4 bullet points, just to give you the how do you have to manage from now on. So probably volatility will likely to remain high. So that is something that you have to live with that, and probably you have to take advantage of that too. So that is also an opportunity. Second, probably economic growth, inflation, interest rate will continue to remain anchored by secular forces. We probably will not see hyperinflation, inflation spiking significantly. Other concept, diversification. Recall, diversification is important not only in terms of different different asset classes, but also with asset classes that have relatively low correlation among them. And then my final comments on this summary is like the risk volatility is also, when you see correction, is an opening for opportunities.
Thanks very much, Daniel. Thanks for that presentation. Definitely a lot going on in the international space, a very dynamic time. So a lot to chew on, but thank you very much for the recommendations and the advice on the portfolio side as well. Starting at the top, taking a top-down approach here. We all paid attention to what Minister Imbert had to say in his mid-year budget review most recently over the last month. And we actually got some good news, which has been the first good news I think we've heard on the local economy for quite a while. So just in recapping that, one of the major items that he would have come across would have been that the TT debt to GDP ratio would have actually fallen from a multi-year high of 85% to about 72% at the mid-year. Taking us back, to pre-March 2020. Now, Trinidad is still investment grade rating. And while the debt to GDP is relatively high, especially versus historical, you can see we were down at 6 days not too long ago. It needs to be taken into the context of the pandemic. Debt and GDP both working against us here, where GDP in 2020 and 2021 would have been shrinking with the pandemic restrictions, and debt also climbing in terms of taking on additional debt to meet social requirements. And essentially keeping the lights on in the country when we are on an economic lockdown. So it was natural and perfectly expected to see debt to GDP raising. This is, a phenomenon that was experienced across the world. So T&T is not alone in seeing this sort of trend. So we're very happy, however, though, to see it pulling back a little bit, given the idea that, we are moving in the right direction, I guess. So in terms of the title of this slide, a little bit of change in fortune. We expect GDP to grow at about 5 to 5.5% this year. That's an estimate from the IMF, as well as about 3% in 2023, 2024. And this is coming on the back of approximately 6 years of contracting GDP. So any sort of advance in that area is definitely welcome news to our country. When we look at the second graph with the orange bars as well, we can see the budget deficits and budget that we've been having over the past couple of years. And again, you can see here we've been running budget deficits, since 2016. In 2022, what we're looking at is probably the highest revenue that we've seen over the last almost decade or so, at about 51 billion, versus again a slight budget deficit with expenditure at about 55. Revenues would have definitely jumped a lot. I mean, you can see the lower 2020 of 33 billion revenues would have jumped significantly over the past 12 months or so, with the reopening of the economy, especially with the higher gas and energy prices that we're seeing. As well, what we're interested now to see is in terms of the spend, what is it going into? So with the additional spend that the government is planning, is it into areas that are going to further develop the economy? We know in the recent budget supplementary, we would have seen that they're planning on paying off some existing debts, VAT refunds, etc. That is going to put money back into the private sector, which is a big positive, because it's going to give them some capital and some impetus to reinvest in the local economy, and continue to grow demand and grow their businesses. And that's going to, should benefit for all as the money continues to cycle within the economy. So changing fortunes may be a bit early to tell, but all in all, things are looking a lot more positive right now than they have over the last couple of years. So the main positives that we've seen coming out of the economy over the last few months has really been as a result of a sharp increase in energy prices. We all know Trinidad is an oil and gas economy, predominantly gas over the last couple of years. And what you can see on the graph or the chart on the left, the orange line is actually the price for natural gas versus the yellow line that's straight and then jumps which is the budgeted price the gray line, which is the budgeted price for natural gas. So over the last 3 months, we've actually seen natural gas averaging about $6.27. And that's after a sharp increase following the Ukraine invasion by Russia. That would have thrown global demand and supply into a little bit of disarray, Russia being one of the biggest natural gas producers and exporters in the world. So we're seeing significant movement in the commodity space. Natural gas prices are now well above or more than double the initial budgeted price and still sitting, healthily above where the revised estimate of about $5 per MMBTU is. So we do expect some further positive surprise or some further upside in terms of government expected revenue over the next couple of months. While natural gas prices are estimated by the EIA to pull back a little bit over 2023, the additional supply, the hike in the price is definitely going to bring some more supply to the market, additional production especially. We're seeing that on the ground here in TT as well. We are definitely expecting them to remain fairly healthy going forward over the short to medium term. You can see the estimate for 2023, while it's about $4.74, that's more than double what the actual price was in 2020. So while it will pull back, it's still going to be fairly healthy, and that's going to definitely support government income and government revenues as we go forward into fiscal 23 and beyond. So the other side of that coin is production, right? So there's price and there's production. With the blue line, what you can see is we've had a significant decline in our actual daily production in terms of thousands of cubic feet of gas produced per day. This is down from a high in 2019, pre-COVID, of about 3.5 billion cubic feet. And we would have dropped as low as 2.5 billion cubic feet over the past 12 months. What's encouraging is that little tick up that we're getting in the blue line over the last 6 months or so into December and January 22, where natural gas production is reapproaching that 3 billion cubic feet mark. And that's an important line in the sand. Coming out of the energy conference is currently ongoing or may have wrapped up yesterday. We heard Minister Young talking about, line of sight on some of these additional projects due to come online between 2022 and 2023 that are supposed to bring our production back up to between the 3 and the 3.5 billion cubic feet per day thresholds, right? So we're seeing additional higher prices are bringing additional production online. Further out, when we look down the line, we see mega projects like BP's Cypre, Manatee, that's done by Shell, which is the Lauren Manatee cross-border gas field that we've heard a lot about with Venezuela. And as well, BP has a large one called Calypso that's maybe a little bit further out. But there's definitely a line of sight and a renewed interest in Trinidad and Tobago's gas production. So we're looking at continuing to see increased production or at least sustained production at the 3 to 3.5 level out over the coming short to medium term, so the next 3 to 5 years, which is really encouraging. It gives government a lot more revenue than they've seen over the last couple of years. I'd suggest, given the price and the expectations for increased production, that maybe we've seen the worst of it. Maybe the worst of it is behind us for the meantime. So a lot of positives looking forward on the T&T Economic outlook overall. Next slide. Thank you. So just moving quickly over onto the market side of things. Something very interesting and what Daniel would have mentioned as well as the US hiking their interest rates recently. If you look to the chart to the right, you'll see the green line, and that is the US Treasury's yield curve. What we would have seen recently is a sharp increase in their short-term yields, anywhere out from 3 months or 0.25 years out to 2 years, where they jump significantly. Even their 10-year bond has increased by over 100 basis points year to date. So when we look at that, something that strikes us on this particular curve, the red line, that is a TT dollar yield curve, is actually below the green line over the short term. So while the US curve has responded really quickly to the increased rates in the States or by the US Federal Reserve, we have not seen that sort of response on the ground here in TT just yet. So while our local rates are a little bit higher than they were to start the year, it's strange to see a negative differential in the GOT versus the TT yield curve. So that would suggest that going forward over the next couple of months at least, we'd expect to see further raise in the local interest rate environment, especially on the short term, to the point where they're at least equal to or maybe a little bit higher than US rates going forward. Now that's going to have a reverberation throughout the economy. That's going to impact, bank rates, bank lending, especially everybody's mortgage rate and whatnot that is floating rate. So we do expect an increase in rates, that we're seeing in the States to drift southwards and to come down into our local market and impact our own local space, over the short to medium term. One mitigant to this is the availability of US dollars. Capital flight is a big upward push on rates. The inability to secure US dollars to invest in the US market to secure the higher rates at this point in time is one mitigating factor that's kind of suppressing our own interest rates on this front. I know we've spoken a lot, and Daniel would have mentioned as well, the correction that we saw in the international markets over the year-to-date period. And so I guess I'm here today to pitch TT equities as a potential tool for diversification. Daniel did mention, diversifying, but not only within a certain space, but, how about having somebody else hold another basket of eggs for you? And so that's one way we can look at this, where I know that people look at diversifying their portfolios within the US market or within the US space, whether it be fixed income or across various equity sectors. But TT equities have actually outperformed the US market over the past 12 months, because while we've seen a sharp decline in their returns year to date, displayed by the orange line, we have not experienced that sort of decline really year to date on the local space. The all T&T index, that's the thick black line, you can actually see has trended relatively stable over the period, while slightly negative, but not nearly as much as what we've seen in the international space. When we're looking at diversification, it's not to rule out TT equities or equities of other jurisdictions when we're talking about diversification, whether it be TT or other emerging market or other all world ETFs or indices, when we're looking at diversifying our equity portfolios to try and reduce downside risk. It really is about diversifying as wide and as far as possible to try and mitigate the downside risk that you experience by having all your eggs in that one basket. The US market would have been significantly impacted by the increase in rates that you would have seen. And as I showed with the previous slide, we haven't seen that jump in rates on the local front. And so our equities have not faced that sort of valuation pressures yet. US equities were flying at multi-year highs, given the increase in monetary supply with the Fed printing money and QE and stimulus checks. We didn't have any sort of impact like that on our local domestic money supply coming out of COVID. So our equities, while they would have raised over the past couple of years, not nearly to the extent that we saw in the international space. And so that leaves a lot less froth to come off the top, a lot less air to come out of the balloon. And so they have held up a lot better than what we see in the international space, especially. So definitely here a case for including TT equities in your portfolio when looking for tools for diversification of risk. Next slide, please. And again, this slide is just taking a slightly deeper dive into the local equity market. Again, you can see here the all T&T index is the strong orange line at the top here that is basically flat year to date. When we dig into it across sectors or across holdings, which is the chart on the right with the red and the green bars, what you can see is it's not necessarily these groupings are broken down by subsector of the market, so financials to banks to conglomerates and manufacturing. It's not the way we see it in the States, where one sector is being slammed. Let's say the technology sector is being slammed. The story in Trinidad is a lot more company specific or driver specific. So across the board in each sector, you may see some red, but you're also seeing some green shoots. Notably, someone like Scotiabank has been performing admirably, while we see a name like First Citizens that really outperformed last year, was up something like 30 or 40%. A little bit of air has come out of that this year. When we look at names like Agostini's or Angostura Holdings, Angostura, of course, is expected to pick up pace in terms of earnings with the reduction of COVID and, with everyone now re-entering the entertainment sector, people heading back to bars and the restrictions coming off. And also Agostini in particular, where we see they really had a growth by acquisition strategy. where they took advantage of the COVID period where some other companies may have been struggling, and they were able to put their cash to work, picking up a couple of different distributors locally and within the region. So their expansion has really paid dividends in terms of their stock price this year as people continue to expect the stock to outperform given what we're seeing in the market and the activity that their management is taking. So on this front, it really is maybe to be a little bit more selective, stock selective, and understand the name that you're getting involved with and the valuation supporting it, as opposed to looking simply at an overall or a sector-specific strategy. Next slide, please. Great. And that takes us just to the end. Just a quick summary about some tenets for investing through uncertainty. As mentioned in the past, and I think Daniel spent some time on this as well, too, fundamentals rule. You really want to get back to your basics, especially in times of market volatility. Stocks with attractive valuations, steady cash flows, and stable operations are going to definitely outperform it during periods of volatility, as opposed to some of the more speculative investments that we've seen come to market over the past couple of years. You can think of something like crypto that has been providing significantly outsized returns, while everything was going well. But it's also taken probably the biggest hit when the market has turned around. So in terms of reducing downside risk, you want to look at fundamentals. Again, you want to stick to the plan. Time in the market will always be time in the market. So you want to maximize your returns by not missing out on market highs and not exiting at market lows. So we know that there's a lot of emotion involved in this sort of volatility that we've seen in the market year to date. You don't want the emotion to take control of your investment strategy. You want to really stick to your plan, understand that if you're in a long-term asset class like equities, you need to be in it for the long term. Chopping and changing every time there's a news headline, you're only going to cost yourself at the end of the day. Another strategy is through continuous investment. You want to be able to make regular contributions to your investments over time. So you can take advantage of these market fluctuations, as Daniel also would have mentioned, taking advantage of volatility. You want volatility to work for you and not against you. You don't want to put money into the account one day and walk away from it. You want to continue to place pennies over time, and that way it can compound and you can actually take advantage of something called dollar cost averaging and buying at a lower price than you may have initially entered at, so reducing your average cost and then your upside potential. And it already trails back to the last one here, which is diversification. You want to reduce your downside risk by spreading your bets. And of course, understanding your personal risk tolerance is going to help you with that in picking the right investments for you. And you definitely want to always avoid chasing returns. That never ends up well. And with that one, thank you very much. I'll turn it back over to Sapphire to begin the Q&A.
Thank you, Daniel and Christopher. You guys can turn your cameras back on. So lots to consider for sure. I found it especially interesting to learn more about the effects of inflation and where things are heading. I surely do feel inspired to stay the course. Now, we already have some questions in the chat, so let's jump right in. All right, so question 1 is for Daniel, and it's from Michelle. Michelle, your mic is now on. Please ask your question.
Hi, so given the recent sell-off in international markets, is now a good time to get invested?
Very good question. My answer to that is you have to be invested every time, but all the time. It's not about looking for a particular time, if it is cheap or not. I think there's an interesting study, which will be very brief, that shows if you try to time the market, you ended up losing money, because at the end, so if you try to find, this is the lows, and maybe you miss the recent lows and try to catch up the market, and then you will end up losing more money than just stay invested. What does it mean? Stay invested is just not stay invested in any asset class. It's having a strategy. And I think that is the key. So having a strategy in your portfolio, that will dictate your if it is a good time to invest more or not. So without a strategy, it's very hard. There is not a strategy. Otherwise, if you are trying to time the market, it's not the best strategy. So always have your strategy first, and your strategy for your portfolio will dictate when is a good time to move from one asset class to another.
Thank you.
Okay, thank you so much, Daniel. I see that Michelle has one for Christopher.
Thanks again. So, do you expect this sell-off internationally to negatively impact the performance of the local stock market?
Another very interesting question, Michelle. There are a lot of dynamics at play. Of course, investor sentiment is a significant one. Folks see the market crashing somewhere. Maybe they say, let's take all my money off the table, something like that. So it's not to say that the two are unrelated, but the factors that are driving the sell-off in the international market, we haven't seen those factors locally as yet. One of the main ones is the increase in interest rates by the Federal Reserve. I would have showed in my graph there where local rates are still relatively low. So you're still going to get a much higher rate of return, let's say on a dividend yield, than you can on short-term paper in the TT space. We know that local stocks trade at significant discounts, like on a valuation, a PE type basis compared to international stocks. So the names that have been hit the hardest in the international space are those who were trading at really stretched valuations, that when interest rates rose, they were no longer able to support those valuations. We haven't seen that at play in the local spaces yet. We have much lower valuations here. The PEs, high single digits to low double digits versus 18 to 25 times in the international space. So we don't expect the same sort of impact on the ground here in TT. Even if local interest rates do start to rise, we have a lot of mature companies with solid cash flows and strong dividend yields. So it's really going to help them retain value and attractiveness to investors. So to cut a long story short, no, we don't expect to see that same sort of sell-off from the international market transition here into the local space. So thank you for your question.
Thank you, Christopher. I'm seeing two questions for Daniel. Let's go with Daniel DS first. Your mic is now on. Please ask your question.
Hello, good afternoon. So my question is, there are several factors that influence market performance, right? And you've listed several of them, but what would you identify as the most significant risk that could impact the market outlook as you've outlined it?
Yes, it's a broad question. We experienced, there are several risk factors so far in this year. Even I've been surprised how fast many things evolve. But if I have to pick one, I would say that inflation risk is the most important one, because there is one, first of all, is we're coming out from a pandemic. So there is supply chain problems. So inflation is picking up, but how the Fed will react to the inflation, how will catch up? They're already behind the curve in terms of hiking rates. So if inflation risk continue to be dominant in the outlook, so probably will be something that we have to deal for many quarters, and probably that would be a long-lasting risk factor that most investors will have to wait on in their analysis. So that would be my main risk right now that I will say that will prolong in time.
All right, and now Mary, who also has a question for Daniel. Your mic is now open. Please ask your question.
Thank you. Are there any areas of the market that have been positive this year, and what is your outlook for them?
Thank you for the question. Well, at the beginning of my presentation, I showed that fixed income and equity underperformed, so they performed relatively well in any segments of the market. So only commodities perform relatively well on a year-to-date basis. However, I would say that there are a couple of pockets or segments of the market. I mentioned about high-quality corporate bonds, for instance, focus on intermediate part of the curve, which looks relatively attractive. So this, in general, the balance sheet for these firms are relatively good, low leverage, much better yield compared with a couple of years back. So and probably default risk will continue to be relatively low in the coming quarters, considering that most firms, or if not even in high yield, have managed to tap the market and refinancing their short-term debt, move the debt maturity wall to many years later, like 2028, 2029. So financial conditions are proven to be tough this year, but some pockets in the segments, the corporate bonds, after all the sell-off that we've seen, probably is an attractive segment of the market that I would probably suggest if they fit in the portfolio of the investor portfolio.
Okay, thank you so much, Daniel. We have one more, but this time it's for Christopher. Daniel P., your mic is now open. Please ask your question.
Thank you, Sapphire, and good afternoon to everyone. Christopher, my question is specific to Trinidad markets, and it's actually, how do you think the rising commodity prices are expected to impact our local market here?
Thank you for the question. So again, it's going to be a multifaceted type of impact. What we saw recently, commodity prices are affecting the consumer on the ground. Recently, we would have seen an increase in the gas price here in Trinidad. So that's one way that commodity prices are affecting us. That's definitely going to hurt people's disposable income and some of their, decision making. Should I buy a new car at this time? Do I have money to go, let's say, to Movie Town because I have to put an extra $50 in my gas tank every week? So it's going to affect some certain consumer behaviors. However, though, I think maybe what may override that is the impact it's going to have on the government's own balance sheet. So again, our government is a rent taker from the commodity space, as well as one of the biggest spenders and drivers in the market. I believe also the biggest employer in the country. So the additional income that they can get from the higher commodity prices, they can turn over into infrastructure projects, into increased hiring, into development type of projects, and new industries and that sort of thing. And so I think that should have an overriding positive impact on the local market. This is going to have an impact on our local stocks, as a lot of these large names that we have on the market are direct suppliers to the government, as well as to beneficiaries of the government spend. So once we start to see the increased spend in the market, it's definitely going to have a positive on our local listed equities. Thanks for your question.
All right, thank you so much, Christopher. Well, it's now 4 p.m., so this brings us to the end of today's episode. We know that you may have more questions for our team, so please feel free to email us with your questions and we will surely be in touch. On behalf of the team here at Scotia, thank you for joining us for the Scotia Insights, an original web series. Stay tuned in the coming days for a link to the event page with a recap of today's content. Thank you so much again to Daniel, Christopher, and the marketing and tech teams for putting this event together. My name is Safai Mohammed, and it was my pleasure to host you today. Take care, everyone, and please stay safe.
Scotiabank. It starts with you.